Applied Materials is the world's largest supplier of semiconductor manufacturing equipment, providing materials, engineering solutions to help make nearly every chip in the world, according to Morningstar. As you can see here on the fast graph, this is a plotting of earnings and dividends going all the way back to 2002. The company has an October fiscal year. When price is added to this graph, when you add weekly closing stock prices, you can see several very important attributes. Number one, you see that price follows earnings. The company has a semi-cyclical history, but since 2013, after the recession of 2008 and 9, the company's really gone through a strong growth spurt, as you can see by shortening the graph. But the problem is, as fast as the company grew, it was clearly overvalued in 2022. Now, recently, this bear market that we've been finally entering here in recent weeks and months has really brought this stock to an attractive valuation for those who are interested in long-term total return. Hey everybody, this is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. Once again, I want to welcome you to another one of our Subscriber Request Tuesdays. This is where subscribers to our channel ask me to cover certain stocks. Now, I usually get a lot of requests. I'm trying to limit it to 15 to 20 names every week, and I may even try to cut it down some more, because what I'm really looking for is, interested in, I should say, is number one is what you guys are interested in. That's very important in this process, so that's really great to know that. The second thing is I try to look for companies to feature in these Tuesday videos that also provide some lessons or some information and general insights into sound fundamental value investing for sure. So this week I've got 15 stocks that I'm going to be covering for you. And as you can see, they're in, semiconductors like Applied Materials, the first one. I've got building products, specialty chemicals, leisure products in Brunswick. I got regional banks. I've got financial exchanges in Coinbase, which is a very interesting one. I'm going to look at a railroad today, CSX, electrical components and equipment in Generac Holdings. They primarily make generators. Diversified banks would be another one. This here is an Indian bank. I'm going to look at Philip Morris, I call it Philip Morris. His real name is Altria. It was the original Philip Morris. That's why they kept the symbol MO. It's had some, interesting things happening to it recently. I'm going to look at Rio Tinto, which is diversified metals and mining, more of a commodity play. Raymond James Financial, which is investment banker and brokerage. TROW Price, which I didn't cover last week when I covered asset management and custody banks because it didn't have a credit rating, but I was asked to cover it, so I'm going to cover that. And Whirlpool, and then finally a Canadian company, Sleep Country Canada, symbol ZZZ. So without further ado, let's go ahead and get looking at these companies in alphabetical order, as I like to normally do. So we start out with Applied Materials, which I kind of briefly talked about in the intro to this video. And the things that are very important here, again, there's issues about how investments work. There's also discussions or insights rather into valuation and how important it is. And you can see this has normally been about a 15 multiple company historically. And then you can see that, in 2021 and 2022, it got up to where the PE ratios got into the mid-20s. They got really high. And that was, exceptionally high. Now, that was also during a period of high growth for the company. You got to be careful when you shorten the time frame. You can see that gives us a totally different picture as far as total growth, because that's a time for this cyclical company in nature where earnings were growing at 24%. But I want you to note that the market was pricing it at around 15 or 16 times earnings. This blue line is 16 times earnings. And you can see that it was below that quite a bit at that 14 or 15 multiple, in spite of the fact that it grew. And that's because of the persistence. But the point I want to get at is that the operation of the business is what generates, the returns that investors get. So when you're investing at a time like when it was massively overvalued, with PE ratios in the 69 and 70 range, you could have seen that even though the company made money, you would have seen a negative rate of return for many years. Subsequently, when the company began to grow very fast, we had some really great returns, but then we had some, issues where the market got irrationally exuberant, pricing it far beyond what the market has normally awarded as a PE multiple for this company. Applied Materials now looks very attractive. If you look at it from a standpoint of forecasting, it doesn't offer much in the way of dividends, but you can see it's already starting to recover. It does still offer a slight margin of safety. It's expected to grow double digits for the next couple of years. Long-term growth is expected to be double digit. But again, I want to remind you with the cyclical nature of this company. So there are some things you want to consider, but it's a very high quality company. It's A-rated. It has modest levels of debt, offers just slightly over a 1% yield. It does have an earnings yield over 7%, which I like. This is more of a total return investment, an investment in a technological behemoth that is basically, one of the primary stalwarts. As Morningstar said, they help make nearly every chip in the world, every computer chip in the world. Next one I will look at is A.O. Smith & Company, which is building products. Now remember, if you're a subscriber to FastGraphs, you always go to external links and go looking at what the company does for a living, how they make their money. That's a very important feature there, because the goal here of this research tool is to help you research stocks deeper and faster and have some fun doing it as well. Now, again, you can see the effects of overvaluation. The market does get overly zealous sometimes, but when a stock gets highly valued, like A.O. Smith was, for example, back here in 2018, you can see that a simple misstep where we had a couple of down years of earnings have really brought the stock, down dramatically. And then we saw the price get irrationally exuberant again. And now recently in this bear market, the stock is coming into close to being at fair value. It offers a 2% yield. Earnings yield 5.8%. I'd like to see it a little higher. In other words, I still consider it fully valued, but reasonably valued at this point. It's within the fair valuation range. I would wait on this one, but this is a very good company as well. It has a modest amount of debt. It's involved in building products, which has been a good thing. I also want you to notice the dividend payout ratio, which is the area below the white line here, is actually very low. So the company has a good historical dividend record. You can see that, where they've had many dividend increases. There was a time back in the past where they maintained their dividend with a very low payout ratio. And now the earnings have increased and they still keep a relatively low payout ratio, but the dividend has been increasing nicely in recent years. Another factor to consider, but A.O. Smith is beginning to look attractive, but I'd still be waiting on it. The next one on the list is Avient, which is specialty chemicals, and specialty chemical companies all tend to look like this. Now, one of the concepts I like to point out when I'm doing videos like this is my concept that it's a market of stocks, not a stock market. Take note that each company you look at is different. There's some similarities. So far, we've looked at some pretty good cyclical companies here, what I would call semi-cyclical historical norms. And you can see that where the earnings, sometimes grow and then sometimes falter during different times. This company is currently paying 2.27% dividend yield. It's corrected into fair value territory. It does offer a margin of safety. It is expected to grow very fast, so this would be a good total return opportunity perhaps, but as always, I would expect you to do your research. Long-term growth is expected to be 15%, but remember, cyclicality is something that can always rear its ugly head. The company started paying a dividend in 2011, and if you look at what it's done since then, it's grown the dividend at double-digit rates ever since, so that's really a good sign. You can buy it with a 2.25% yield and, possibly get some growth yield and some nice capital appreciation. But once again, we see the effect that valuation has. When the stock got really highly valued here, you went through a period of several years where you really didn't make any money. That's always be aware of valuation. Like I always preach, measuring performance without simultaneously measuring valuation is a job half done. And just because a stock has a good historical number, like you would see it from here, you would also be very wise to consider that the stock was overvalued at that time, because future performance going forward, once it got overvalued, certainly did not repeat what the past had shown. Always keep that in mind. Here's Brunswick, which is, leisure products, everything from bowling balls, etc. Remember, you can always go into the company here and look at, what the company's doing. They're into boats and brands. I always think of them as bowling balls, but they also make, a lot of other features in the company and, sporting equipment, etc. This has been a kind of a hot area. They have a very low payout ratio. They do offer a 2% dividend yield, but that's primarily a function of how inexpensive the stock is. It's trading at a very, very low valuation. It does have a really strong margin of safety. If you're a long-term investor, remember the short run, things can always happen, in the short run that are unexpected, but in the long run, where the company's business goes is where you would expect the stock price to go. So this stock looks like a very attractive valuation right now, but it's moderately speculative. It is investment grade, does have a triple B minus rating. It doesn't pay a lot of dividend, but the dividend has been growing in recent years at a rate that I think is pretty attractive at over 16% a year. It's been, it's outperformed in recent times the S&P 500, but, recently it's had a big correction. So now it looks like it's, become pretty attractive. It's something, if you're a value investor, this is what you're looking for in the stock. Citizens Financial Group, it's a little bit iffy in terms of its growth. It's only been, publicly traded for 7 or 8 years here. It does offer a nice dividend yield. By historical standard, it's very inexpensive. It is expected to have a down year. When you see something like that, see the price low, because one of the things that, subscribers talk about all the time is that, there's a reason why the stock is down. There's always a reason why the stock is down. But the question is it a permanent reason or is it something temporary that you can exploit? You've certainly got a great margin of safety. Analysts are thinking the stock is going to do well going forward. And I want you to notice that forecasts for 2023 have been steadily increasing as well as 2024. And, the same can be said of 2022, which, originally, that brought the stock price down when we started to see a little weakness in earnings. But now the company is expected to recover. And, this could be a great time to be taking a position. You've got a nice margin of safety and you've got a 4% dividend yield that's been growing very nicely. Now, this is one that's very interesting. This is crypto, Coinbase. If you go on their website and look at their website, you would learn that over 98 million people and businesses trust them to buy, sell, and manage their crypto. But we all know crypto has been really taking a beating lately. And this is something that I think is really important. This was a very highly speculative stock. You can see the IPO, the classic IPO pattern, came out with a lot of hype and hysteria, I like to call it. It corrected dramatically. Then it got very excited again. And then crypto is now taking a big hit and the company is not making any money and is not expected to make any money in the foreseeable future. So, I don't see, even though the stock has fallen dramatically, if this doesn't start turning out to be some profits, then there's a problem. Now, you can also look at companies like this from things like price to sales and so on. So if you're a real speculator, you might like the price to sales graph here. But I do believe you've got to be, cognizant of the fact that this company is, bleeding red ink right now. And also that, there are other metrics like you would normally look at are expected to recover. But I don't think the stock, even on that basis, is cheap enough yet to really at least get this value investor's attention. The next stock I want to look at is CSX. I love this company. It's a great railroad. As you can see, it's normally been about a 15 multiple company with a lot of stocks that got irrationally exuberant for the last 4 or 5 years, got pretty overpriced. The stock's beginning to correct. I would still be patiently waiting for this company. It's getting close to fair value, but I don't believe it's there yet. I think, this market is going to be more negative than it was in the last 5 to 6 years. So I would still look for the company to give me a better entry point than what it's trading at now. Offers a 1.36% dividend yield and an earnings yield of only 5%. I would like to see it higher. It does have a very excellent historical dividend growth record, and it's really got an excellent earnings growth record too, with occasional bounce of cyclicality, but it's been a pretty consistent grower. And of course, this is, I think, a Warren Buffett favorite, if I'm not mistaken. But again, I'd like to buy this company cheaper if I could find it cheaper. Generac is, best known for their generators, where they're, powering a smarter world. So, with all this going on in green energy and shortages and blackouts throughout the country, this company's been growing nicely. Their dividend record, I'm not sure, they must have paid a special dividend back here. They've got pretty decent growth at over 18% a year. But once again, you can see how in the short run, markets get really crazy. Earnings determine market price in the long run, as I've always said, but emotions determine market price in the short run. And here we had, greed turning into fear, and the stock is now starting to come into a reasonable buy. This would be more of a growth stock. It does have expectations to grow at 16% a year on average over the next couple of years. Long-term growth is also expected to be double-digit at around 10%, but I don't think this stock has corrected far enough yet to be attractive as a growth stock investment. The problem is if you overpay for this stock, you're not going to get the benefit of the growth, and you certainly don't get any dividend income. Note that they're not paying a dividend. They have paid a special one in the past, but they're currently not paying one. Again, you can always look at these stocks from all these different metrics, and I always encourage subscribers to do that because, there are a lot of other ways to skin valuation. You're starting out with valuation. It's always nice to start out with earnings because the bottom line is important. HDFC Bank is a bank out of India. It has one of the better records. It has had some dividend issues. It is an ADR, so you want to take that in consideration. You've got currency conversion. The market has, because of the consistency of this company, has put a premium valuation. But during COVID, they did, noticeably cut their dividend. They have a very low dividend payout ratio. If you look at their dividend payout ratio, it's been, 14, 15, 16%. So there's a lot of room to grow. The dividend historical growth record has been very good at double-digit records. But, as I mentioned recently, with COVID, which is a 100-year event, they had some problems. The company did get reasonably priced then. Once again, it was overvalued coming into this bear market. It's now become attractively valued, but there is no real margin of safety here, and it might actually be on the full valued side rather than, on the attractive. From a normal multiple, the market does like to apply a premium. That's another thing you want to take into consideration, because I want to remind you, fast graphs does not dictate valuation, it reveals it. The market likes to put a premium on this stock. If you're willing to take that as a fact that you can hang your hat on, then hang your hat on it. But keep in mind, fundamentally, the stock is now still slightly overvalued, in my opinion. Altria is the old, Philip Morris, as I say, symbol MO. They've recently talked about outlawing their Juul. They spent billions of dollars on that. According to Morningstar, and I find this very interesting, I'll go ahead and show it to you real quickly. I'm a subscriber to Morningstar. If you look at what Morningstar is saying, they give it a 4-star rating. They say the final nail in the coffin for Altria's Juul investment, but the FDA ban has little impact on our valuation. Morningstar never felt that Juul was going to really make them any money. It wasn't going to really add to the earnings of the company. So they feel that this is a non-event. This is a stock you can get with an 8% dividend yield. It's all about the dividend yield with this company. Growth, historically here has been slowing down. It's been averaging about 6 or 7%. Forecast growth is expected to be about 5.5% going forward. Long-term growth is expected to be about 5.5%. So, you're really looking at a very high dividend yield here and a very low valuation. The company does offer a very nice margin of safety. The normal multiple has been, around 14 times earnings. Their intrinsic value multiples, in my opinion, is around 15 times earnings. So there's actually a lot of money to be made. Not only are you going to get can you get a high dividend yield here, but because of even possible PE expansion. If you look at this stock historically, note that it's typically traded at 15 times earnings or higher. We did have this irrational exuberant period. The stock has been trading at a very low valuation recently, but it's been paying a very, very generous dividend. And that, to me, is the big reason to own this stock in, this market. Rio Tinto, as I mentioned, is a, commodities company. Again, if you don't know the company, you can go into, the company's website and you can look at, all the various products that they sell, copper, boron, aluminum, and, all the other products, iron ore, et cetera, but it's a commodity company, and as such, this is a true cyclical. I want you to notice that they've had pretty good dividend record where they've paid special dividends, and the dividend has grown. Dividends expected to falter. The company's earnings are not expected to be very strong. That partially explains, the price. The one thing is trading at a very low multiple. It does offer a current, high dividend yield, but the question is that dividend yield sustainable? So I would call this a speculation. It is considered to be an A-rated company. I just don't like the cyclical nature. When you're looking at forecasts for this company, going 2 years out, the analyst scorecard has been very spotty. And so if I'm looking at forecasting here, analysts are expecting earnings to be dropping. Since it does pay such a high dividend, you want to look at this from a standpoint of cash flows. Cash flows have generally covered the dividend. Free cash flow has also generally covered the dividend, but not always. If you look at it from a standpoint of price to sales, you'll see that it's trading at a reasonable price to sales here. But the problem is, from a buy and hold perspective, if you're not careful with valuation, even if you buy it at a reasonable valuation, it's possible to go several years with very low rates of return. Just keep that in the back of your mind. I call this a speculation. The next one is Raymond James. Here's looking at it from a price to sales point of view. It looks very expensive on that basis, but when I look at it from a standpoint of operating earnings, it looks very, very inexpensive. It's got a great earnings record and a very consistent multiple that the market applies around 15 times earnings. So being able to buy it at 12.67 times earnings would indicate a buy. It offers 1.4%, almost 5% dividend yield. Performance has been stellar. They've actually outperformed the market. And I do want to emphasize, as I say that, that's given the fact that the company is actually undervalued. And I still would argue that the overall market's overvalued. So if you're looking for a growth stock with a dividend kicker, I would consider Raymond James a good buy here. It's just one rating short of A-rated. It's a BBB+ rating, which is investment grade. So I like that aspect. You know, this is one that, given the vagaries of the market right now, you'd want to be careful with short term. But long run, this is probably a great entry point. T. Rowe Price was one I didn't cover last week. I was asked, to cover it last week. I used A-rated as a criteria. You can see they have no credit rating, but they've been a good, solid grower. They are expected to have a negative growth rate this year. The company does from time to time pay a special dividend. Their dividend record has been stellar compared to the S&P 500, and their actual growth rate has been stellar as well. And that's, again, considering the fact that the stock is actually significantly undervalued now and the market is overvalued. So this would be a good entry point. You got almost a 4% dividend yield. I do think the key question here, and I always want to alert you, is that you could still have some negative reports coming out over the next couple of quarters before the stock started to stabilize. But I do believe the risk is already priced in here. From a normal multiple point of view, the stock does offer some really intriguing opportunities. And I also want to point out it does offer almost a 4% dividend yield. So I do like T. Rowe Price very much, and I do have a small position in this stock. Whirlpool is, the appliance maker. I think the important thing to look at when you're looking at this graph is the company is somewhat cyclical. Notice the blue line here. Even though technically a stock growing at 7% a year ought to command a 15 PE ratio, a normal multiple. In my opinion, the market has liked to price this at around 10 or 11 times earnings. So when you're looking at forecasting here, the normal multiple probably makes the most sense to look at around a 10 multiple. And even at a 10 multiple, this stock looks very intriguing, offers over a 4% dividend yield. Its historical dividend growth has been very solid at over 7% a year. There are years where they've frozen the dividend, but their dividend record is good, not great, but it's very good. And this would be a great time to be entering into Whirlpool, in my opinion, if you're a long-term investor. In the short run, just about anything can happen, as we know. Finally, last but not least, is Sleep Country Canada Holdings. This is a company it's a mattress retailer throughout Canada. Again, notice the blue line. It has good growth at over 20% a year. Little bit of cyclicality. The market likes to price this at about a 15 multiple, though. Keep that in mind. So when I'm looking at forecasting here, I'm going to use the normal multiple at around 15 times earnings, but we've got a really great margin of safety, a 3% dividend yield. The company has no credit rating, which means they didn't apply for it. But even with very modest growth going forward, this stock would be a great buy, but it's expected to grow double-digit rates. So this is a true growth stock, potentially with a very high dividend yield, and is trading at an extremely low valuation. So, if you're a value investor like me, this is one that would really get your attention. You might want to take a closer look at. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation, bringing you another subscriber request. Remember, I've just highlighted these companies. I always encourage you to do your own research and due diligence to dig deeper. If you're a subscriber to FastGraph, we facilitate a lot of ways for you to do that. The external links can take you to other sites. Some of them you do have to subscribe to, I'll admit, but if you do subscribe to them like I do, like the Wall Street Journal or, Seeking Alpha, etc., you can, get some really good information. I also subscribe to Morningstar, so I can usually get good research on a lot of stocks that way. But you can also go through the financials and, look deeper. It's sites like Seeking Alpha where you got crowdsourcing opinion. So you want to do your research, but the key is, does the stock offer the opportunity to do that research? Is it worth your time? And I think, you know, the answer to that is always try to look for stocks that offer good value, because ultimately, when you buy at value, you're able to fully participate in the company. If you really admire the company and overpay for it, the company does great and you don't make any money. But if you can buy the company cheaply, or at least at fair value at the minimum, then you can fully participate in what you see the company offering you. Anyway, thanks for watching. If you haven't already, subscribe to our channel. If you're looking for a good tool to research stocks, take a deep look at fast graphs. It's a great tool. I always tell people I wouldn't even consider investing without it. I want to thank you all for watching. We'll see you again soon next week on this subscriber request. I'll also be featuring some dividend growth stocks later this week in some upcoming videos where I get a little more in-depth on them, so you might want to watch out for those. Thanks for watching.